The story begins with a number that once represented catastrophe but now barely causes a shrug: $1 trillion. A deficit so large it once signaled economic emergency now appears every year, printed like a recurring chapter in America's financial diary. Not long ago, the idea of a $1 trillion budget shortfall created waves across Washington, triggered urgent fiscal debates, and sparked nationwide concern. Today, it has morphed into a constant rhythm in America's economic heartbeat. The country that built the world's most powerful economy has developed a deep reliance on a habit it cannot break. This is not the common tale of debt accumulation or the basic story of politicians overspending. Something deeper evolved beneath the surface, something that turned deficits from temporary tools into a structural obsession. This is the hidden architecture of America's trillion-dollar deficit addiction, a system built on financial engineering, political incentives, global power plays, and economic illusions. A system that grew quietly, unnoticed by most, until the numbers became too large to ignore. A system that created winners, created losers, and created a dependence that cannot easily be reversed. This documentary uncovers the mechanics behind this addiction, the origins of America's deficit dependence, the forces that accelerated it, the breaking points that shaped it, the fallout that continues to compound, and the repeated attempts to fix it that only made the problem more entrenched. To understand how the United States reached permanent trillion-dollar deficits, the stage must be set properly. America's current financial reality did not appear overnight. It emerged from decades of systemic redesigns that altered how the government issues money. Three pillars shaped the modern landscape. 1. The transformation of the Federal Reserve from a passive stabilizer to an economic engine. 2. The shift from commodity-based money to fully elastic currency. 3. The rise of global demand for U.S. debt as the backbone of international trade and finance. In the early 20th century, American leaders designed a system that required discipline. Spending beyond your means came with immediate consequences. Currency was anchored to gold. Imports and exports needed balance. Even in war, deficits were temporary distortions expected to shrink afterward. Over time, that world dissolved. Politicians found incentives in deficit spending. Central bankers discovered tools to accommodate it, and global markets began to depend on it. Slowly, deficits evolved from emergency measures to normal practice and finally to something closer to an institutional necessity. Trillions became part of the landscape because the system demanded them. The story begins long before trillion-dollar deficits emerged. It starts with the origins of modern American finance. The gold standard's discipline before the 1930s, deficits were not easy to accumulate. The gold standard acted as a leash. Every dollar issued had to be backed by gold. Government spending could expand only as far as the Treasury allowed. If the country imported too much or overspent, gold reserves fell and forced immediate correction. Global investors judged a nation's financial health by the shine of the metal in its vaults. America grew rapidly under this system but remained constrained. Politicians could not simply print money to solve problems. Wars, recessions, and social programs required hard choices. Deficits existed but remained short-term. The Great Depression breaks the old rules. The collapse of 1929 brought new realities. Banks failed, unemployment soared. Prices fell uncontrollably. The gold standard prevented expansionary spending at a time when the economy needed oxygen. President Franklin Roosevelt needed room to maneuver, and the gold standard did not give it. So the rules changed. Gold's link to the dollar loosened. The government gained the power to issue more currency without immediate metallic backing. This shift did not create deficit addiction, but it opened the door. America began to experiment with spending to fight crises. World War II and the new normal. Then came the largest spending surge in U.S. history. War production demanded unprecedented government borrowing. Deficits soared. The Federal Reserve coordinated with the Treasury to finance war bonds, control interest rates, and keep money flowing. The war ended, but the financial tools remained. Policymakers had seen that large deficits did not instantly collapse the empire. A psychological barrier had been shattered. America learned something dangerous. Large deficits were survivable. This lesson would echo for decades. The post-war boom and the pressure to maintain prosperity after World War II, Americans enjoyed rising wages, suburban expansion, and massive industrial growth. This prosperity created political expectations. Voters became accustomed to economic abundance, and leaders used fiscal policy to maintain it. Large infrastructure projects, military expansion during the Cold War, and social programs demanded constant funding. But raising taxes was unpopular, and spending cuts risked political backlash. The government discovered a flexible solution: borrow now, pay later. 1971, the break that changed everything in 1971. President Richard Nixon ended the dollar's direct convertibility to gold. This decision removed the final restriction on currency creation. From that moment forward, the United States could issue dollars without the discipline of gold backing. Foreign nations could no longer demand gold in exchange for dollars, which meant the limit on deficits became political, not physical. The New World allowed money supply expansion without natural restraint. Inflation surged in the 1970s, but the system did not return to old rules. Instead, policymakers reshaped the financial landscape. Deficit spending gained legitimacy as a policy tool. The 1980s, aggressive borrowing becomes strategy. The Reagan administration brought a turning point. Tax cuts, military buildup, and economic stimulus dominated the decade. Deficits ballooned. Yet despite warnings, the economy grew. Wall Street flourished. The dollar strengthened. This era produced an idea that would become central. Deficits could finance prosperity. The pattern continued under both political parties. Borrowing became bipartisan. Cutting deficits became political theater. Meanwhile, global financial markets began absorbing U.S. debt at unprecedented levels. The rise of the dollar standard. As globalization accelerated, America's deficits served a new purpose. Nations like China, Japan, Germany, and oil exporters relied on U.S. consumers to buy their goods. The dollars they earned returned to the United States as treasury purchases. This created the dollar recycling system. America consumed. Foreign nations exported. Surplus countries bought American debt. American deficits fueled global trade. The world had tied its financial stability to U.S. borrowing. Deficits were no longer domestic issues. They became global economic infrastructure. The 2008 financial crisis, when the housing bubble collapsed, everything changed again. Financial markets froze. Banks faced extinction. Millions lost homes and jobs. The government responded with enormous bailout packages, emergency spending programs, and unprecedented monetary expansion. The deficit surged. But instead of shrinking once the crisis passed, it remained elevated. The reason stemmed from structural shifts. 1. Economic growth slowed permanently. 2. Interest rates remained near zero. 3. Debt loads from the crisis embedded themselves into the economy. 4. Global demand for U.S. assets increased rather than decreased. 5. The political system lost the incentive to reduce spending. The United States entered a new era where deficits no longer expanded during crises and contracted afterward. Instead, deficits persisted as a permanent feature. The 2020 shock and the trillion-dollar norm, the pandemic, solidified the pattern. Trillions were issued to stabilize the economy. Stimulus checks, business loans, and emergency programs flooded the financial system. Even after the immediate emergency faded, trillion-dollar deficits continued. Structural spending commitments, higher interest payments, aging population, slower revenue growth, ongoing global demand for treasuries. These created conditions where deficits no longer dropped back to pre-crisis levels. The addiction had formed. America's trillion-dollar deficits are not abstract numbers. They create ripple effects across every part of the economy. Rising interest costs. When deficits grow, the government issues more bonds. As debt accumulates, the interest bill grows. Today, interest payments have become one of the largest annual expenses in the federal budget. The government now spends more servicing past debt than it does on major programs. Hidden inflation pressure. Deficit spending injects money into the economy. When combined with supply constraints or aggressive fiscal stimulus, it creates inflationary pressure. The past decade revealed how quickly inflation can escalate when spending surges. Wealth gaps widen. Large deficits often accompany aggressive monetary policy. Low interest rates and asset purchases inflate stock markets and real estate. The wealthy benefit the most while wages struggle to keep up. The result is a widening gap between asset owners and wage earners. Global dependency on U.S. instability. Foreign nations invest in U.S. debt because they need dollar reserves for trade. This arrangement creates global dependence. If America reduces deficits sharply, global liquidity shrinks. If America increases deficits too rapidly, inflation threatens global markets. The world is locked into America's fiscal cycle. Political paralysis. Deficits have become tools of political power. One side pushes for tax cuts, the other for expanded social programs. Both rely on borrowing to avoid difficult trade-offs. The result is a political system reliant on deficits for survival. A system with no exit. America's economy grew around deficits. Financial markets price assets around them. Global trade depends on them. Domestic politics drift around them. The addiction is no longer temporary. It is structural. Throughout modern history, leaders have attempted to solve the deficit problem, but each effort ended in partial success or complete reversal. 1990s surplus experiment. The Clinton administration briefly achieved budget surpluses. But surpluses created unintended consequences. The Treasury reduced bond issuance. Global markets felt a shortage of safe assets. Financial institutions struggled to find stable collateral. The dollar system became strained. When the tech bubble burst, deficits returned instantly. The system rejected the surplus like a body rejecting a foreign substance. Political promises without follow-through. Every decade produced speeches about fiscal responsibility, yet none addressed the underlying dependency: rising entitlement costs, global reserve currency obligations, debt servicing, military spending, voter expectations. Cutting deficits required reducing one or more of these pillars. No administration managed to achieve lasting reform. Monetary policy as a crutch. Each crisis created a stronger role for the Federal Reserve. Low interest rates made deficits cheaper. Quantitative easing absorbed debt supply. Emergency programs normalized large fiscal expansions. Rather than fixing deficits, monetary policy enabled them. The forces driving America's deficit addiction mirror past cycles but now appear on a larger scale. The 1970s parallel: currency without discipline. After abandoning gold, deficits grew rapidly. Inflation surged. The Fed attempted to control it with sharp rate hikes. Today's inflation surge reflects similar underlying dynamics. Elastic money supply, large fiscal expansion, global supply chain dependence. The scale is larger, and the numbers are bigger, but the underlying pattern remains. The wartime parallel: emergency spending without retraction during World War II, huge deficits financed national survival. Today, multiple crises, financial, technological, geopolitical, and public health trigger similar bursts of spending, but without the post-war contraction. Emergency spending has become standard spending. The empire parallel: dominant powers financing global systems. Historically, dominant empires accumulated debts to maintain global influence. Britain did it. Spain did it. Rome did it in its own way through resource extraction. The United States today finances global trade, military infrastructure, and financial stability through deficits. Global leadership creates global obligations. Shocking modern data points: annual deficits regularly surpass $1 trillion even in stable economic periods. Total federal debt exceeds $34 trillion. Interest payments alone approach $1 trillion yearly. Mandatory spending continues rising faster than revenue. Foreign central banks hold trillions in U.S. debt to sustain global trade. These numbers reveal a system that cannot function without constant borrowing. America has reached a stage where deficits are not bad habits but integrated features of the economy. Several forces ensure the addiction continues. 1. Structural spending requirements. The largest areas of government spending grow automatically. Demographics increase obligations. Healthcare costs rise, interest payments expand. Cutting these areas requires extreme measures that no political system can sustain. 2. Global dollar demand. The world needs U.S. treasuries as safe assets. Reducing deficits would deprive global markets of their primary financial foundation. 3. Financial market expectations, Wall Street prices, everything around Treasury yields and liquidity. Dramatic deficit cuts would shock markets. 4. Voter incentives, the public expects services, benefits, and low taxes. Deficits bridge the gap between these conflicting demands. 5. Crisis frequency. Crises now emerge more often: financial shocks, geopolitical tensions, pandemics, supply disruptions. Each crisis demands spending, which never fully retreats afterward. The addiction continues because the system rewards it. 1. America's trillion-dollar deficits are not accidents. They are the outcome of decades of structural evolution, political incentives, and global financial architecture. 2. The system depends on these deficits. Global trade, financial markets, and domestic politics all rely on the continuous flow of newly issued U.S. debt. 3. The addiction creates long-term consequences. Rising interest costs, inflation risks, wealth imbalances, and geopolitical vulnerabilities will intensify as deficits grow. The United States built a system that runs on borrowing, but no system can expand forever without adjustment. The world has begun preparing for alternatives. Shifts in global trade, rising multipolar power centers, and emerging digital currencies hint at a future where America's deficit cycle faces new constraints. The longer the addiction persists, the more difficult the correction becomes. For viewers who want to understand the hidden forces behind money, power, and global economics, staying informed matters. The world is changing faster than ever, and the financial systems shaping your future deserve deeper exploration. Continue the journey through these investigations, support the channel, and explore more stories uncovering the truths behind the modern economy.